Okay. So once again, welcome. Thank you very much for attending this webinar, the Sunday session on commodities, mainly crude oil and various others that are connected or correlated with the commodities market in general. And today is the 11th of July already, 2021. My name is Kenny Simon. For the ones who are new, welcome. And what we are going to be doing a little bit today is just to do a little bit of correlation because we have some news on gold, alert on gold and oil, mainly on gold because of the US, because there's a lot of things that are going on in the States, but there's been a little bit of a drop in the US real treasury yield. US Treasury yield and their real rates as well. A couple of other things that has been alerted just in the very last minutes of the closing of the market as well. So that could potentially give us a little bit of a short-term rise on gold, but whether or not it's a matter of location of the price, as well as where is the location of the right zone of entry for either a buy or a sell, because we are trading CFDs. So CFDs, we have the flexibility to actually look into, buying and selling of any sort of instruments that we can actually see on our MT4 platform. So with that, we are also looking at oil. Oil has got some alert as well, expectations by some experts, especially within the OPEC plus, also experts outside from banks and various other associations actually looking at predicting it to go up to $80. But again, we want to look at the location of the prices and the opportunity of where we can actually trade and when as well, so that we know when to exit the market. That is really, really very important. So yeah, so we have got news on that, and we are looking at loads of commodity action possibly next week onwards, because we are into the summer as well, and various investors and traders, especially how it works. Usually majority of the market, when you talk about US, you talk about UK, you talk about Europe in general, they are all sort of gearing towards holiday time and things like that, and they like the movement of their investments to be more like auto, like run on its own kind of thing. So they will be less involved into it, less watching, less monitoring. So they like to actually trade at this moment of time more on a medium and long term, meaning that they will trade on let's say like gold or oil or anything that would actually be not really driven too much right now. As you can see, oil especially slow down already on all the fundamental factors, things that can move it up and down and things like that. But it's now the decisions of OPEC plus and all that are settling down. And when it settles down the trend as well for medium to long term. So investors and traders at this moment of time, majority of them are looking at trading and leaving it, to trade based on instruments that can actually reach this kind of level, meaning steady type of trend after decisions has been actually made, things like that. So we've been riding a lot of volatility, right? So we ride a lot of volatility based on news, fundamentals, and various other things that are going on, let's say like gold in the US, things like that. But with regards to certain things, predictions with the Delta variant as well and all that, they have forecasted it to be, an issue that will actually still persist for a good 3-6 months, maybe even 8 months, and even more, we don't know. But then they sort of have that recorded already, that this is what the world is going to face, and this is what is going to happen. So then various other countries are actually dealing with it. So with that, in the business world of financial trading, especially for us financial trading online, these kind of things would actually be very much impacting safe havens, especially. So safe havens, it does also include, of course, gold, but oil does come into play. So when oil comes into play with the Delta variant virus rise, expectation to rise, then it has the ability to actually absorb that kind of event to rise in terms of the price because of the demand. The demand would actually increase. Travel, of course, will actually slump down a little bit, but then with this as the risk, commodity prices in general would actually go up. So I think we are looking at trading commodity currencies, but not necessarily buying them. So this is the wonders of trading CFDs, is that we can participate into either the buy, either the fall, or either the rise, right? So I see that there's we are going to talk about that a lot tomorrow because we're going to plan ahead and get lots of trade ideas and trade signals from tomorrow onwards because there's a lot of volatility going to come into the market as well. We will evaluate the fundamental side, but also some surprises, geopolitical surprises in the market that I expect to happen, and that could actually give us a lot of potential to trade, but to trade commodity currencies like Australian dollar, New Zealand dollar, to actually be on the downside as opposed to the upside. So that is majorly factored by what is happening in China. So there's a lot of things that are happening in China. Behind the curtain, there's a lot of tug of war happening between China and the US as well. China with the Euro zone as well. So various other things. It's got to do with the import-export, balance of trade by investors investing in China, from the US and from Japan and from various other places, Europe, Britain, and all that. So now it's the time that they might actually sort of struggle a little bit with certain things, but I'll explain that a little bit more as the course of the week goes on, because it's more of a complex area that has got to do with foreign direct investment in China. So now they might be struggling a little bit in that area, not so much in their manufacturing side. Manufacturing side as well has gone down and stuff like that. But what goes on in China, as you guys know, would actually impact Australia big time. So that is what we are looking at. And also because what actually went on in Australia with regards to its lockdown, very drastic lockdown as of last week as well, sort of already dented that thing between Australia and China. It impacted China. China impacted Australia. So there is a very big link between the two trading partners. So it started off with the Delta variant lockdown in Australia and all that. So naturally, it impacted China big time. But then they're not announcing that to a big scale. But for a country that is reasonably small like Australia, having one of the largest deposits of minerals and one of the largest export trail towards China, it's just got a lot of things that will actually shake the market as well. And then New Zealand dollar together with the US and various other things, it's going to be quite a rocky type environment in trading, but we call it volatility, of course. But then this volatility can feed us with both opportunities and risk. So next week onwards is going to be quite interesting. At this moment of time, in terms of gold is seen to have the ability to rise up, but then we need to be very careful because it might actually be, in my expectation, it might be a rise up like a shock kind of thing, and then to encourage and trick the market that it is actually going to go crazily up now, and then traders will all go in, and then boom, it'll find a resistance level and then come down again, and then so that investors can still buy cheap, and then it will go up again. So this would actually also happen with oil. Oil's prices, before we go to oil, the price to look at for gold, a level that we need to watch for both support and resistance, is 1,850. So the 1850 level is not a level that you should be looking at buying or selling. It's a level to look at whether there are some reversals happening at this level. Okay, if it's coming down and it finds support there, okay, then you know that that acted as a very good support to give it a good rise. But if it is actually falling down from there under the 1850 and coming down, then you need to look at where the support could actually be, because it's falling. So it's falling under the 1850, giving you opportunity, maybe short term, long term, we don't know that yet, but on the downside. But then if it's above the 1850, then it's the upside. But we want to look at that technically right now. But we look at oil first, and then we go on to gold, and we talk a little bit about on the technical side of it. So I'm using all the fundamental factors at the moment, and then give you a little bit of an idea what goes on, what is to expect outside of the chart, and then we try to marry in and use the charts as the window to your market. Look at where the location of prices are, where could you potentially enter, but most importantly, where can you potentially look at levels that can actually act as your risk level to exit, as well as your TP becomes your TP when you actually exit correctly based on the risk levels. Okay, so 1850 for gold to look at. We want to look at that together onto the chart. As in oil is, as I've mentioned, is looking like it has the potential with all the OPEC plus meetings, decisions. At the moment, they are struggling to balance between supply and demand. This is what is going on within the OPEC members and countries. They're trying to calibrate and come back to having the right resonance in terms of the balance between buying price, selling price, supply and demand, things like that. So at this moment of time, they are torn between whether to reduce the output. They know they have to reduce output at some point, but then the demand is just far too much, and they would be in deeper trouble if they actually just cut the supply as well. So this will actually impact the business side of it on a very, very big scale. So they wouldn't do that. So what would probably happen is that they might decide, investors and traders might want to buy at a cheaper price. So what that means is that for the shortest time, there may be a little bit of a fall to the price of the 70. The 70 area is sort of like what gold is what 1850 is for gold. The 70 to 80 dollar area is also that kind of functionality for the oil prices. But then I feel that it has the ability to come down a little bit to the $70 and then rise up from there, and then it has a potential. I think it's trading at about 73 or something like that right now, US oil WTI, but then it has the potential to actually reach the $80. But this is a very big question as well. The market in a way looks like it has to go to that level. It has to rise up a little bit to the $80 area, but then how long would it maintain there and then go up from there or not? It's very unpredictable, because there is still probably another meeting middle of the week, or some news that would come up from OPEC plus as well, and then we can get the whole idea and the picture again. But for traders, investors, there is a room to trade on the buy to reach 80, maybe 79, 90. Okay, use the psychological numbers as well for oil, and not just aim at 80 on the spot. Okay, all right, good. So this is what we're looking at is UK oil. We'll talk about UK oil as well, but probably best if we just go on US oil first and let's look at what's going on. I just like to look at the whole big picture. This is the monthly chart right there. It's very clear, very, very clear in terms of where the price is at, where the location of a risk of a reversal is at as well, and that is very clear in this area right here. So we closed the market on US oil at 74 roughly. Yeah, it's 73.99. So we take it at $74, and we see that there is definitely potential, let's say, of a rise. So let's say we are technical, we look into the technical aspects right now, and for the power of the buy, we are looking at to the left for a bullish candle, right? A bullish mother candle. There is one right here. There's another here, but let's look at this one here, the recent one. And we look at the closing price of that right there, and that gives us exactly at 79.85. So it is close definitely for to what experts are talking about, right? So the experts are talking about, yes, it has a short term hitting 80, most probably will hit 80, and then we'll decide what to do from the 80. These are the words of the most of what's been going on in the news and experts talking and stuff like that. And also, when I'm reading and things like that, researching, I have bumped into this price as well. But then when we are looking into the technical side of it, and based on that mother candle that we have just seen, it is really interesting that the closing price of that mother candle is also at, let's say, it's at 80 as well. And then we see that you have got resistance right there on these two mother candles, bearish ones, and also another mother candle, bullish one right there. As we go on and on and on, we can see that's the end of it. But then this is all the price action that we can actually refer to, and it's really very interesting to know that it matches on the technical side of it with the fundamental, which is good news. So what would that mean? That means for us, for myself as well, if I were to trade on the US oil WTI, I wouldn't actually do my take profit on the 79.85. Where do you think we need to actually have our take profit? Where do you think we need to exit? That is why I say exit is your number one strategy. If you know how to exit it right, you will make that money consistently. So entering, you can enter right now. For example, as soon as the market opens, you want to enter, you can enter. But then 74.10 would probably be quite interesting. A better ideal price based on psychological numbers. So because it's at 74, so I don't think you might be in time to actually target the price at 74.10, because the market may move really fast. So this is already at 74. So for me personally, I think 74.30 above the 74.20 psychological number. So let me lay out the price right there. So what we are doing today is that for oil, I think we are about ready to actually lay out loads of price. So we'll do this together. We'll start off with the monthly chart, but then we'll go on to the lower time frames as well, and travel down so that we can actually get all the little price movements based on psychological numbers as well, so that it fits all type of trader, whether you are, short term, intraday, medium term. At least you know all the levels. If you are medium term to long term, you know the levels, but you can leave it as it is and leave the trade open, and basically follow your risk appetite as well, and your risk management, money management plan, and basically trade accordingly. So now let me put this one here, horizontal line right here at 74.30. Okay, so I prefer to enter a buy or pending order for US oil at 74.30. So I've got a 74.30 price right there. And then of course it's a big gap between 74.30 to 80, right? But we can definitely trade in stages on that. So hence the reason we want to firstly look at the big picture, and then we can sort of look at how we are going to trade and manage our trade in stages. In my opinion, the way it looks like, for example, here, there is a possibility I'm not sure, I haven't measured yet the how you call that, the probability, how high the probability of this pattern is, but this is a sharp pattern right here. I will evaluate that a little bit deeper. That actually means that if this sharp pattern works really well, that means the rise can go really crazy above this area right here, maybe to come back to this area right here. So this is just a sort of a rough visual guess, okay? Not yet a trading decision, not yet a high probability decision right yet, but then there is a possibility of this forming as a nice sharp pattern. But how does it actually increase in its probability is based on what's going on outside of the chart. So what is outside of the chart, decisions by OPEC plus, what goes on in the news, geopolitical, and everything else that has been decided would then make this pattern more and more solid, or not make it solid at all and break that pattern and basically cancel it out as well as a sharp pattern. So this is a sharp, possible sharp pattern. The other thing as well is that because it is a possible sharp pattern, it could potentially be, if it is a probable sharp pattern, then it becomes a probable Z pattern right here. And that means that this increase would actually go up to this length right there, okay? And you can see that it coincidentally matches with this area right here. So I'll just draw out roughly, only roughly, okay? It's not a set in stone type pattern yet. Looking at it, it needs to break up and above certain level first, driven by fundamentals. Okay, so that is the possibility of it right there, and then come down. As you can see, if it comes down, it comes back down into the area that we have rightly allocated to trade for the week as well. So this is really interesting. So here, and this is how your Z pattern looks like, okay? So a rise, if it breaks that area right there, it's got some powerful bullish candle to bring it up and up, even from here as well, to go up and up. But then it does depend a lot on fundamentals as well, and we need to monitor both. So, and here, if I draw a trend line right here, in red, this is that it's already gone past the trend line as well. But what could potentially happen is going up, coming back down to this trend line, and then boom up. So it's a zigzag type movement. So here, this is your Z pattern. The Z pattern is usually the upper mouth of the sharp pattern. Okay, so I'm just going to keep the drawing so that we can monitor whether or not it is following through this pattern as well. So this is your sharp pattern right there. Okay. Right. Go. There we go. So you got your sharp pattern right there. And this area here, part of the sharp pattern is your Z pattern. So the Z pattern is usually amalgamated, combined with a sharp pattern, which basically is good because we can then use both patterns to confirm one another. And within the sharp pattern or whatever pattern, usually then you can see zigzag going up, right? So if it's a zigzag going up, most probably you will also be able to find the geometric ABCD pattern inside. So you are trading the geometric ABCD pattern inside the normal pattern, like sharp pattern or harmonic pattern. Any other pattern is a big picture. This is your big picture. Then you use the geometric pattern to trade inside that big pattern. Okay. Then you combine it with fundamental as well. So this is the rough route map of trading US oil. But at this moment of time, of course, we are waiting for 74.30 to trigger. And then now we look at where to exit, and we go down, we go lower and lower to look at exhaustion of price to the left. Okay, like now, let's say it's on the way, let's say it goes upwards, then we need to look at where potentially you would be able to find resistance levels. So here, for example, now above that here, this one here, this is an area to look out for as well, right here. And let me use the red line as your exit line. Okay, so if I put this one right here, this points out at 76.62 or 63. So I need to adjust that to 76.40. Okay, so we're adjusting that. As you can see, as we travel lower and lower and lower, then we will actually get smaller gaps. We will get big gaps first, and then the gaps will be smaller, okay, will be reduced. And that is your sort of short-term trading in stages type area. So 76.40, 40, okay, there we go. So I have 76.40 right here, right now. So your 74.30 is your pending entry. 76.40 is your exit. But again, 76.40 is very, very far, right? So this is for medium, long-term traders and all that. So now we go lower and lower time frame. We will get lower levels as well for the shorter term intraday traders as well, okay? So now we will go to the daily chart. Okay. As you can see, sometimes as we go, to the lower time frame, then we may get lack of data as well. Then we have to go back to the higher time frame again. So here, as I go on to the daily chart, I see that we have got an area right here for resistance. So then I will use this area here to point me out. Now it is, oh, did I do a mistake? So this is, it points out to 74.63 on daily chart. So we need to adjust this exit here to 74.40 under the 50 psychological level. So then we adjust this to 74.40. So as you can see, it gets, lower and lower. So we have got areas to consider. And then you go to monthly chart, 4-hour chart. Then we can see very clear resistant area right there. Okay, this is your clear, that's 75.29. I think 74, 75, 10 right here. Okay, exit area. So we plan all these exit areas first, and then we may need to go in again to actually just brush up the entries as well. Okay, after you exit, you can enter again using psychological numbers. Okay. There's 75.10 right there. I'll ignore this one. That's the one I've used. And then you've got another one right here. That is the opening price of that mother candle right there. And that's at 75.77. Very nice. So 75.70 should be another exit point as well. So 75.70 right there. We'll take this one away and 75.70. Okay. There you go. So you've got very nicely even psychological number and exit prices. So this is quite interesting, and usually it happens a lot whereby you can see it's geometrically aligned, meaning it's measured quite nicely. Look at all this distance right here. Okay, it just happened on its own, just us evaluating the market, looking at the to the left with price action and then tweaking it with psychological numbers. Then you get all these red lines that are very equal in terms of its distance with each other. So which is a very good sign. So sometimes, these kind of thing may look like it's why, how, magic or something, but it's not. It's just because price has already been sort of, it's like the universe. You've got the mathematics of all the planet floating there. It is the same thing with the space of the financial market as well, in terms of the price that we cannot see. We cannot see a lot of physical things. We cannot see the price of US oil going up, but we cannot really see people are buying and barrels are moving. We cannot see all the actions of it, but it's reflected by what they are doing outside into the price action, and the price action works very, very nicely with what's already been planned inside. Not planned, but it's just the nature of mathematics of price action as well. Okay, so this is very interesting to see all these. So we've got that blue line right there with exit price. So 73, 74.30 is your entry price right there, right? So we've got an exit price 74, yeah, 74.40. So that's quite a nice buy area right there. So if we go on to the neutral time frame as well, we're able to see all this distance clearly as well, and then we can see some short-term type exit areas as well. So as the price moves upwards, let's say goes on to triggers 74.30, and then you exit at 74.40. So you obviously want to re-enter again, right? So your re-entry price will be 74.60. So I will put in here the blue line for your entry and your support area, 74.60. So 74.60 right here is your buy again, okay? So now you've got 74.60 right here. Now, when we look at the 1 hour chart for the intraday traders as well as the shortest term trader, we can see you've got an area right here to watch out for, a resistant area that is really in a line as well. So then if I take this and I look at the area, it's at 74.84. If I were to rise a little bit, 74.80. Okay, so here it's a little tricky. It's not really for short-term traders. If you want to get that, then you can enter at 74.60, but make sure you exit for short-term ones. Yeah, for the medium long term, you want to leave it. You've got bigger risk appetite, you can actually leave it for it to go, because we have got a nice candle right here that may support us all the way upwards. But then for maybe it might do a little bit of correction in this area, and then smaller traders prefer to re-enter later on and then exit first, because they don't like to see the floating, for example. So if you don't like to see the floating too much, and you want to be clear with knowing that you are trading in stages, but you are trading safely in stages, and you want to see more profit so that it motivates you much more, then you want to look at all this level and exit with smaller. So if you are entering at 74.60, you exit at 74.60, 74.70 or 74.75, but 74.70 would be better. So your area is small right there. Okay, so I hope that makes sense. Here, if you look at the shorter time frame, the thing about shorter time frame is sometimes when you look at the 1 hour chart, 30-minute chart, you have got more to stress about, actually, to be very honest. Because if you look at 30-minute chart, 1 hour chart, and then you look to the left, you will see all these things. You will see this, you will see this, but then when you go onto the daily chart, you don't see that so much. You see, you see more a clear way, but then that does also need to answer the question of whether you have enough risk appetite, your trading style. Is it short term, long term, stuff like that. So here, for example, if I'm looking at the monthly chart itself, it has the power, it has bullish, bearish candle and all that, but it also has some fall I need to really pay attention to from this area here. Okay, and this one here is really powerful, very significant area. So that on a bigger picture, when you look at bigger picture perspective, it should actually be able to guide you on your psychological side of it. When you see something in the big picture, you are able to know where your border is at the very long term. Only so you know that you come down to the time frame and it start to help you do the shorter term type resistance, and then the medium term, and then the high, what do you call that, the long term. So when we start with the long term, we're starting with the map first. And then when we go down the time frame, we are then planning our route to go to the closest city. Then we've got the step-by-step type sequence. So, ancient times as well, people say, your journey always begin with the first steps, right? Your first 100 steps, your first 10 steps. But then that whole journey maybe is 1 million steps, but that 1 million steps away needs to be broken down to various smaller steps, right? So that smaller step is usually used by intraday trader, shorter term. You need to think that way, but you don't need to think that if you look at long time frame, longer or bigger time frame, you are trading the bigger time frame. This is a big misconception that most of the traders, especially intraday or even scalpers, they tend to think that no, we don't want to look at the long time frame because we are not long-term trader. No, you do need to look at long-term time frame for info gathering, data, and all that. The big picture, the map, your map is actually with a longer time frame. Okay, but it does not mean you're going to be trading based on that long term. No, but you need that essential data. So you do need to refer to it, which basically will keep you safer as well. And then you've got a sequence. Then when you start to look at the big data and know how to chunk down the data and move to the lower time frame for any instruments at all, then it will help you to consistently trade, because you are training your brain. Okay, you train your brain to be busy with sequence and what to look at, and that will actually definitely encourage you with discipline and patience, and then eventually you will have consistency. Then you will focus on that more. The more you focus on that, the better it will actually be for you, and you will be able to trade on pending orders as well, and you don't need to monitor it and a lot more. So that is basically how I trade, and this is basically the best way to maintain yourself emotionally as well, and be able to do other things that are more exciting as well. Not only trading. Trading is great, is exciting when the market moves, right? And when the market moves your direction, then you get more excited. Then you think it's more exciting. But what if it's actually moving opposite your direction? Then you think that it is really risky. Then when you start losing it, and then you go under the break-even point, then you will think it is so risky and it's very mean market towards you, right? So the market has got no emotions, but it is really important for us to know how we are dealing with the market. This is very important. What's our philosophy of trading? How do we actually see it? This is very important. Whether you're trading oil or anything, it doesn't really matter, because it's the same chip that you have that will be able to trade anything, because we're trading CFDs anyway, right? So we've got US oil right here. It's got a nice mapping through. So I think throughout the course of the week, we will be going through together in all our sessions as well. Mondays, Wednesdays, and Fridays. We want to look at all this map. We want to look at how the prices are actually going through all these areas in order for us to exit as well rightly. Now, on the monthly chart, we look at this price right here. As it triggers the prices, we've got an area right here that we need to take a look at as well. So that's another resistant area right here. So I'll keep polishing it and then share it as in our sessions, in our next sessions as well. Okay, because we want to look at gold and various others. So here, I will adjust that to 86.10. Go. So the next entry after 86.10 will be 86.30, right? So I'm going to take that 86.30 right there. Change that to blue. Right, there we go. Ah, it's very close. So we need to go to here. There we go. It's better that way. Ah, okay. Oh, it's far, far away. Right. No problem. I think we need to focus on the shortest ones here. That's enough for now on that. And then we will polish it up together much, much more. Okay. All right. So that's US oil. This is on the 4-hour chart right now. Okay. Any questions at all, guys? Anything that we want to polish up? Polish our clarity on various things got to do with US oil, especially WTI. Questions? No questions so far? All good? Oh, good, brilliant. Okay, so let's move on to UK oil before we move on to gold. Okay, so UK oil, as it is trading, is a little bit on the slow side. It's been quite slow in terms of how it has actually been moving. But let's take a look at the price projection from before. It has. Let's see where it has actually reached as well. So all these price right here, okay, that's off the 9th, okay, and it has actually reached 75.37 price, right, roughly, and you can see that it respected the resistance area right there as well, began to fall right there. 75, let me just 75.38, let's say 75.38. So if I go back here to look at what we have written the other day, a couple of weeks back, I think. So we hit TP1 754. It went back again to that area. So this one is far reach, far reach. Okay. So we'll still keep that one there. At least it has hit your TP1. That's good. Maybe we need to reevaluate that and change all the TPs as well. So, okay, let's do that. Let's see what we need to do. I'm looking at the monthly chart right now, and we've got the buy zone still intact. That blue zone is still your buy zone right there. So your last sort of TP area possibly is still the 79.10. So what we can do is to get rid of all these one here. Let's do a fresh evaluation of UK oil. Okay, and we can see that at this moment of time, it is quite clear. You've got a resistance right here. You've got some here, right? But then the upward type movement may be fueled by a previous mother candle, and that mother candle is right here. Okay, it's this one right here, most recent one. We've got some here, some there, but this one here, right? So the closing price of this is here. Okay, this is based on monthly chart. So I'm going to just color this red, not color it red, but change it to the red color as your resistance potential zone. And that points out at 82. Okay, so 82.12. So what I would think is an ideal exit area as well would be better if it is under the 82.00. So 81.90 should actually be your area that you need to exit as well. So this is your potential exit. TP area is 81.90 before it reaches 82.00. Okay, so 81.90 right here. So we're doing the same thing that we have done in US oil. We look at the bigger picture. We slice down, we cut down the levels so that we can trade in stages. Now, it's really obvious we have got it in a potential, we've got this bearish zone here as well, okay? But at this moment of time of how it's moving with fundamental, with, the way it's actually moving now above all three lines, and it's building higher high and lower and higher low and all that, it's basically giving us more bias to the upside. And also because of how US oil is factored at the moment, it's expected to rise. So we've got potential right there. But when we look at the 4-hour chart and we slightly, glance to the left, we see this area right here, very, very obvious as well, right? So we want to mark that closing price area. That closing price area is pointing at 75.32. Okay, so we have got 75.15 area right here. This is not an ideal price. It closed at 75.15. So whatever we do, probably we are going to buy only 75.30, right? 75.30 and above. And that does reflect this area right here as well. So it would be above, it would be at a safer area. But what I would prefer to do is to trade a buy for UK oil only at 75.35 and above. Okay, so 75.35 just to keep us a little bit safer. Okay, so we put it right there, 75.35. So this is 75.35, a little bit above there, a little bit above there, which is a little bit better. Okay, because here this is a giant drop. This giant drop here is very powerful, and we see it in the 4-hour chart very clearly as well right here. So it's not really a good sort of area to enter and things like that. So then we look at area for us to buy 75.35, let's say, only then we want to buy. So I'll change this to blue. And if this were to be blue right here, that marks your support area, entry area as well at 75.35. So then where do we actually exit? Now here, okay, this is also very tricky right here. Okay. Obviously, if it is the 4-hour chart, we put it there, it will be just too little, right? But let's look at powerful candles as well. We can see that this one here is a little bit longer bearish candle right there. Then we see that the bullish candle has taken it up to this level as well as right up there. Let's not look at the high levels yet. We'll look at lower levels. So lower levels, if I take a look at this area right here, where would that should be? It would be at 75.55. Not really giving us that nice area, right? But it might give us safe area right there, you see, because this is where it might want to reverse as well. So for conservative traders like myself, I would prefer to still push the price up, let the price go up and up much more. Let's say I would love to only enter the market at 75.60. Okay, let's say as a conservative trader, because of how the market is looking for me, it's just a little bit on the risky side of it with all this resistance around. So I would like to be clear out of the way of all these areas. So 75.60 would give me a better feeling to actually enter the market, 75.60, and then I can aim at this area right here. So this area here, for example, pointed out 7600. Okay, so then I would think that I can make a little bit by actually exiting at 75.90. Okay, so 75.90. I'll change that to red. Okay. So I've got a bit of a buy area that I prefer, basically at 75.60 and then exit at 75.90. Okay, that would probably be better for me. I feel a little bit safer in this area to trade as opposed to this area right here, because anything can happen at any moment of time. So it does also depend on your trading style, your philosophy with risk, you know, how you feel. You want to take that earlier right here as well, as soon as it goes at 75.35, and just leave it and take it. It all depends on your risk appetite as well. So that can also be done. There's no right or wrong. It's just that it's ideal price, and you need to watch out where you exit. So whatever you do, whether you enter at 75.35 or 75.60, make sure you exit at 75.90. That's it. As easy as that for UK oil. Is that okay? Right? You can do a pending order. You want to trade only when the market opens, and then you enter the market 75.35, or as soon as the market opens tomorrow, then you do a pending order 75.35, and then you choose where you want to exit 75, 90, for example, then you leave it like that, or you ignore the 75.60 entry. So you've got two entries, actually, UK oil 75.35 or 75.60. But for me, that's why I've mentioned it many times before. The entries does not matter. The number of entries as well, it doesn't really matter for me too much. But where do I exit? That's why I only have one exit point. All right. So imagine you are in a building, and then the fire alarm goes out, and you will look for the closest exit, right? And you wouldn't be thinking about entering the building again, correct? You will be thinking about exiting. So that is the main philosophy principle as well when you're actually trading. It's when you're actually trading in a very volatile market, you need to picture yourself entering a building that's on fire, so that you will be safer in thinking of exiting, not on entry. Okay, because a lot of traders get very tempted when there is a lot of movement in the market. They think of entry. But the thing is that you might be entering a building that's on fire, and there are people who are exiting at the time that you are thinking of entering. So you need to actually be very aware. Look to the left whether or not people has exited the building before in the past. Were there reversals in the past as well that is really close to you, to your current price? So that is where you need to think about. Is not the entry so much, because you're already entering that market in a way. Even though you're not trading, your mind's already entered the market, the space of trading. So you need to think of exits. Okay, exits makes you money, not the entries. All right. Okay, any other questions, guys? This is UK oil. All right, if not, then we move on to gold. All good so far? Clear on UK oil? We'll go on to the gold at the moment. Okay, gold, what's happening? Yeah, so we are looking at a short-term type gain on gold, but then as you guys can see, we have got all this movement here. Now I'm looking at the 1 hour chart, okay, and a lot of other traders are also talking about patterns, head and shoulders and things like that. Now there is a possibility of a head and shoulder pattern right here. This is the first shoulder, this is your head, this is your second shoulder. A head and shoulder pattern. This one here is a quite sort of valid type head and shoulders because of that big four right here, and then we've got this. So it is more a reversal pattern at this stage of a head and shoulder pattern, not an upside down or an inverse head and shoulder pattern would be different. This one here is a head and shoulder pattern, the classic one that might be signaling more fall of gold. Okay, so I will tell you how it would actually be seen as from a technical perspective. It needs to break the neck area or the trend area right here as well. So if I put it like this and put it like this, perhaps change the line right there. Okay, so it needs to break these areas right here. Okay, and once it breaks down, comes down lower, breaks that area, comes down lower, might come back up here, and then boom, come down a lot. Okay, so this is just to keep you guys aware that there may be a possibility like that. We don't know what's going on yet, because we've mentioned about some fundamental news about gold having a rise up a little bit, but that rise up may be very short-lived as well. And that is what's going to trick majority of traders, that rise bursting upwards. I see that we may have more selling, and more selling of gold would actually be more solid for us to trade on the downside as opposed to the upside. But again, I'm not 100% sure. I need to look at how it burst up and the nature of it, and then we see whether or not we can actually enter the market on the buy side. But at this moment of time, we've got various hints that tells us the ability of it to fall. Okay, so what I would like to do is I want to restructure all this drawing that I've done for the new week, so that we start afresh and we look at where we actually stand. So on the 1 hour chart, you've got a head and shoulder potentially. Okay, so it needs to, and for it to actually come down on the 1 hour chart, you need to break all these areas as well. So yes, there are some potential support area as well. We can look at that, but let me do my favorite thing, which is going on to a high time frame and then give you that whole picture of what's going on. They're just price action. So the thing about gold as well is that we don't have any more reference right there. This is all we've got on the monthly chart. Okay, it looks like a cup as well. And we've talked about it as well. If it's a cup and then it needs to come down here at this 50% of this bottom and top of the cup. So it needs to come down to a level before it finds a very good area to bounce up from. And then from there on, maybe we can look at it. Now, in my technical type perspective, if I look at this as a cup and handle potentially and all that, I see that it needs to actually come down, and the best sort of support, would actually be at this area right here. Yeah. And usually what happens is when it comes down to create the handle of the cup, it is usually the distance of about 50%. So if I pull that there from bottom of the cup to the top, I get that area exactly at 50% as well. So I don't know whether it's coincidental or not, but it looks like it is an area for support right here, okay, as it drops, which is really far as well as 1550s area. So this is scary thought if you think about gold has to go, or maybe possibility of going down to that level first before it finds a good timing for that. So hence the reason it is really struggling. I mean, we are looking at gold prices really struggling with any type of fundamental. It goes up a little bit and then it comes down a lot. It goes up a little bit, it comes down a lot. And then when I look at the, what do you call that, the monthly chart right now, the thing is that it is actually giving me a lot of hints of a lower high and lower low as well, you see. So we need to monitor this on a shorter time frame. So hence the reason we see the big picture, but then we keep on moving to the lower time frame and keep monitoring it based on all time frames as well. So this is basically the best thing to do. Here, for example, if I look at just this area right here, I can pull it down as my A to B area as well. So that's A to B point. So that's my A point. Oh, it's not moving now. Right. So if I take that and I drag that as my A point, I leave this one down. Here, B, I can see that this area here is really close to the 61.8. I pull this one down. Okay. Right. So that is projecting to this area here. Okay. Based on the geometric pattern, let's say. So, okay. And earlier on, we did our 50% roughly, and that's also quite close here. These are all areas of support. Potentially. I'm just looking at the bigger picture. Okay. So now let's look at gold again from just this area right here. All this price action right here. Okay. So price is to the upside. And if it is to the upside, expected to actually go up a lot more, let's look at where could it actually start reversing from a big picture perspective. Okay, we use this as a red line. We look to the left for mother candles as well. Okay, so now as it goes up here, look at the shortest one. See, it could actually reverse here, even around here as well. So let me do that. So do we have mother candles bullish ones? Yes, for sure. We've got that there, that, and that to fuel the market upwards. But then we need the bearish mother candle to tell us roughly where could it actually be thinking of reversing. So that gives us 1847 gap right there. Okay, so 1847 potential reversal area. Maybe you want to exit at 1845, let's say. So 1845. So you want to buy right now. Yes, it's possible. You've got all this power as well for the buy, but again, it does depend on the fundamentals, what's going on in the States. If it's confirmed, all the dollars actually just going down, yields are continuously going down, and then the situation is giving rise to interest in buying gold, then yes, you can actually buy, but then make sure you exit at 1845. Safer that way for the 1845. And then we'll look at further. So at this moment of time, just to keep you safe, that's probably an area, but that's based on the monthly chart. Now, on the weekly chart, we can see that the bullishness does actually end around here. So that is another exit area, and that exit area is at 1830. Okay, so you've got 1830, you've got 1847 or 1845. So then as we move to the lower time frame as well, you can see that you've got one immediately around this area that coincides with this area right here. You have to take consideration onto this short-term area as a potential resistance here. Very powerful area, I think. And that's at, okay, 1811. So basically we are at 1808.22 as of closing of Friday. And then we have got a potential resistance area at 1811 area. But I think to be safer is to look at this area right here, which is your bullish candle ending right there at 1814. So let's say potentially, I mean, if I were you, I would prefer to trade only at 1815 and above. So 1815 will be my sort of area of support or my area of entry, as opposed to anything lower than that, because it's just a bit too risky. So then I put it here as blue, and I'll change that to 1815. Okay, 1815, let's say. And we do it like that. Okay, so 1815 by area, you've got 1830 to exit and 1845 to exit, or 1847, entirely up to yourself to exit as well. Okay, some of you guys may be looking at the daily chart right here. You want to adjust the 1847 a little bit lower here. Okay, based on this one here, 1842 instead. So 1843, let's say. Yeah, so you've got one entry point right here. You've got two exit points potentially, right? So you can exit early 1830. You can actually exit later 1843. Okay, that's for the buy for gold this moment of time. And if we look at 1 hour chart, you can see we've got a bit of a correction right there. We've got some bullishness as it goes up. We've got that area to look out for as well. Depends on which time frame you're looking at as well, and how early you want to exit as well. You can look at that, and it does depend on your risk appetite mainly, how you want to leave it open. Okay, how long? All right. Okay, any questions, guys? All good so far? You guys are very quiet today. Any other questions? No questions at all? It's an hour past already, but then no questions from you guys. Any questions, guys? Gold, oil, or any other? You want to take a look at? Yeah. Any questions, guys? No? You guys all right? All good? All good. Brilliant. 1815. Gold. Ah, yes. Yeah, you can. It's not, it's just to actually be sure to, yeah, 1815, you can actually do that at 1815. But I'm not concerned about the price of entry. I'm just looking at, because I'm not sure whether you can grab the price at 1815 when the market opens, but potentially, yes, it depends on how the market moves. Because what if tomorrow, you've got something that have triggered the market in Asian Open, and then suddenly boom, goes up, but then it passes your 1815. That is why I put that as just as a reference point. Potentially, yes, you can enter at 1815, but basically to enter at any time when you see the bullish candle, and then it is confirmed as well by fundamentals that gold is getting stronger because of the weakness of the US, and then you see bullish candle, then you enter basically. So that price, I'm not sure will it actually be exactly 1815 at the time that you are watching it when the market opens tomorrow. But yes, technically from 1815 onwards, you can actually buy. Yeah. So it does depend as well how far would it actually be have moved once you have monitored the market. I mean, what if it actually burst through, and then by the time you look at the market, it's at 1828, which is very close to 1830 exit price, right? Let's say as an example, and anything can happen. But let's monitor the price as of tomorrow, and you need to look at two things. You need to look at whether or not the news and everything is supporting the strength of gold. The risk sentiment is because of fear, and a lot of things are going on. And then there's a bullish candle going up and up in most of the time frame. Then yes, you can enter at that time straight away. So it's not about entering with the price, it's entering with the price at the time that you're looking at the chart, whether or not it's supporting the bullishness of gold. Then you enter. Okay, so that's why entry is not the most important thing. Okay, yeah. So it could be 1820, you never know. 1817, you never know, right? But monitor the market tomorrow and see, because what if the gap up is so high that it sometime, you know what can happen? The gap is so high, and then there is a lot of movement, and something happens somewhere, and boom, it went up and it hit all this already in advance, so you don't have trading opportunities yet for these ones, but then later you get other trading opportunities. So whatever it is, when we look at the 4-hour chart, it's really clear you've got a bearish zone here as well, so you need to watch out there. This is a very strong fall of price from a mother candle that does not have a wick at the top. So that's an area you need to really draw a red line on there, okay? Because that is an area you need to exit no matter what. And no matter how interesting the market looks like with a bullish candle going up, and you don't want to have stop loss, but you need to have a TP, okay, to exit. Okay, so you need to exit before that area somehow, re-enter again later on, but exit here. Okay, 1861.76. There you go. That's it. All right. So yeah, be very careful. Tomorrow, when we monitor the prices, it's really important for us to get a clear idea what's going on in the States. We look at the strength of the US dollar, And once we get all that ideas, then we are able to actually sort of forecast it better, the movement of gold's prices. All right. So we have got oil. Okay, US oil. Yes, sure, we can. We have got US oil. Right. So again, I am emphasizing on exit prices, even though I've got my entry price here, because your entry price will change because we're talking about this on a Sunday, when the market is not open. So your entry price right there is just as of a guidance, but then we never know what will happen. The price might already been triggered based there. So you might be late into entering as well. So you need to adjust your entry price with the market movement at the time tomorrow. So let me make this bigger. Okay, right. So the entry, which I'm not really bothered about, is at 74.30 or 74.60. But exit prices, which I am really very concerned about, usually is either you've got 75.10 to exit, 75.70 to exit, or 76.40 to exit. You've got three TPs potentially, three areas of exit for your potential buys for the US oil. Okay. All right. Good. So you've got your exit prices there, Alfred. Yeah. Good. Okay. Perfect. So that is for US oil right there. When you look at the bigger time frame, it always most often it gives you better confidence of the data. So I always like to use the monthly chart, weekly chart, depending on which one's clearer, but higher time frame to give me that risk level as well. Okay, in case because we usually get quite misconceived in the market, especially short-term traders. They don't use the data of long-term time frame, and the long-term time frame is what's going to save you actually from a lot of even short-term resistance, because as you go on to high time frame, you look at the big picture as we have done it today, you go low and lower, you will find that level that is closer to you to exit. You see, so that is why exit is your number one. All right. Okay, good. Brilliant. Okay, guys, I think that's all I have for you guys this morning. It's almost 11 at this moment of time. I want to grab a quick bite before I go and fetch my son. It's really crazy temperature here in Cyprus, 35 degrees, and it reaches 40 as well degrees when it comes to summertime, June, July, especially July. So we are in the peak of the summer period in terms of temperature as well, in terms of the heat and craziness. So yeah, if I have time, I would dip into the sea for just a little bit before fetching my son as well. So yeah, that's basically it. So meantime, if you guys have got any questions, you can DM me directly and we'll take it from there. And we'll see you guys tomorrow in tomorrow's Monday session. Okay, guys, no questions. So we will end the session for today. Is that okay? All good? Yeah. Happy Sunday to you too, Alfred. Take care. All good. Yeah. Okay. To you guys too. Take care. And bye-bye. And we'll see you guys tomorrow. Take care, guys.